In this video, we'll reveal 3 under-the-radar stocks that could genuinely change investors' lives over the next decade if their businesses continue executing at the pace they are today. These are not household names, but each one operates in markets with enormous long-term demand, possesses meaningful competitive advantages, and has multiple catalysts that could fuel years of compounding growth for patient investors. Our first company is a business that is quietly transforming the treatment of neurological disorders while building one of the most promising late-stage pipelines in biotechnology. Despite delivering exceptional revenue growth and expanding into massive untapped markets, many investors are still overlooking what could become one of healthcare's biggest success stories over the next several years. Let's dive in. The first stock is Axsome Therapeutics, ticker symbol AXSM. One of the biggest mistakes investors make is focusing only on today's earnings instead of tomorrow's opportunity. The market often rewards companies long before they become financial giants because investors recognize that the value of a business comes from the cash flows it can generate over many years, not just the current quarter. That is exactly why Axsome Therapeutics deserves serious attention. The company is focused on therapies for central nervous system disorders, one of the most challenging and underserved areas in medicine. These conditions affect millions of people, significantly reduce quality of life, and often have very limited treatment options. That creates a powerful investment thesis. When a company develops treatments that solve major unmet medical needs, physicians adopt them, insurers increasingly reimburse them, and patients benefit. If multiple successful therapies reach the market, revenue can grow exponentially without the company having to reinvent its entire business model every few years. Axsome is beginning to demonstrate exactly what that kind of growth can look like. Its flagship product, Auvelity, has rapidly become the primary growth engine for the company. Originally approved as a treatment for major depressive disorder, Auvelity addresses a massive market where millions of patients continue searching for therapies that work faster and more effectively than older antidepressants. The commercial momentum has been remarkable. During the first quarter, Axsome generated revenue of $191.2 million, representing 57% year-over-year growth. Even more impressive, Auvelity itself produced approximately $153.2 million in sales, increasing about 59% from the prior year. Those numbers demonstrate that physician adoption continues accelerating as awareness grows. Revenue growth is exciting, but what really changes the long-term outlook for a biotech company is expanding the number of patients who can benefit from an already approved medicine. That is exactly what recently happened. Auvelity received a label expansion for the treatment of Alzheimer's disease agitation. That may sound like a relatively narrow medical condition, but the commercial opportunity is anything but small. More than 5 million patients in the United States are living with Alzheimer's disease agitation, and before this approval there was only one approved medicine specifically targeting this condition. Think about what that means. This is not a crowded market where dozens of competitors are fighting over the same patients. Instead, Axsome is entering an area with enormous unmet demand where physicians have had very limited treatment options for years. That kind of market dynamic can dramatically accelerate commercial adoption. The beauty of label expansion is that the company does not have to build an entirely new commercial organization. Its existing sales force already understands physicians treating neurological disorders. That allows management to leverage infrastructure that already exists while expanding the revenue opportunity for one of its most successful products. Investors often underestimate how valuable this strategy can become. Launching an entirely new medicine is expensive. Expanding an existing blockbuster into another indication is frequently far more efficient. Margins often improve as revenue scales because many fixed costs have already been absorbed. That creates operating leverage. And operating leverage is exactly what long-term investors love to see. Of course, Auvelity is only one part of the story. Another reason Axsome stands out is that management has deliberately avoided relying on a single product. Today, the company already has multiple commercial assets. Sunosi continues serving patients with narcolepsy and excessive daytime sleepiness. Symbravo, approved last year for migraine treatment, gives Axsome another commercial growth driver that should continue contributing as physician awareness expands. Each successful product strengthens relationships with healthcare providers while generating additional cash that can be reinvested into research and development. That creates a positive cycle. More revenue funds, more clinical trials. Successful trials create more approvals generate more revenue. The cycle continues. But perhaps the most exciting part of the investment case is what still lies ahead. Axsome's pipeline remains deep, diversified, and surprisingly advanced. The company is currently conducting Phase 3 studies for AXS-14, an investigational treatment for fibromyalgia. Fibromyalgia affects millions of people worldwide and remains notoriously difficult to treat effectively. Patients often cycle through multiple medications without achieving meaningful relief. Any therapy capable of improving patient outcomes in this market could attract significant physician interest. And AXSM is not stopping there. Management plans to initiate additional late-stage clinical studies for AXS-20 in schizophrenia before the end of the year. Schizophrenia remains one of the most challenging psychiatric disorders to manage, making innovative therapies particularly valuable if clinical data supports effectiveness. Meanwhile, another important catalyst could arrive even sooner. The company is awaiting approval from the United States Food and Drug Administration for AXS-12, a potential treatment for narcolepsy. Every regulatory decision matters in biotechnology because each approval has the potential to unlock an entirely new revenue stream. The market constantly attempts to estimate future cash flows. Every successful approval improves those projections. Every commercial launch increases the probability that management can execute again. Eventually, investors begin assigning higher valuations because the company has repeatedly demonstrated that it knows how to discover, develop, gain approval for, and successfully commercialize innovative medicines. AXSM appears to be steadily building that track record. There is another reason why experienced biotech investors pay close attention to companies like this. Pipeline diversification reduces risk. Many early-stage biotechnology companies depend almost entirely on one experimental drug. If that clinical program fails, shareholder value can collapse overnight. AXSM looks very different. It already has multiple approved products generating meaningful revenue. At the same time, it maintains several promising late-stage candidates that could become future commercial products. That combination significantly changes the overall risk profile. Instead of betting everything on one scientific breakthrough, investors gain exposure to several opportunities developing simultaneously. That creates multiple potential paths for long-term growth. Financial performance has already started reflecting this strategy. The company has steadily improved commercial execution while narrowing losses as revenue continues climbing. Earlier annual results showed revenue growing more than 60% year over year, while losses improved significantly compared with the previous year, demonstrating that the business is moving steadily towards stronger operating performance. That progression matters. Wall Street often becomes willing to assign much higher valuations when a biotech company moves from being viewed as a pure research organization toward becoming a sustainable commercial enterprise. AXSM appears to be making that transition. Another factor supporting the long-term investment thesis is the sheer size of its addressable markets. Depression affects millions. Migraine impacts millions. Narcolepsy remains underserved. Fibromyalgia affects millions. Alzheimer's disease agitation represents another enormous patient population. Instead of chasing tiny niche indications, management consistently targets diseases affecting large groups of patients where current treatment options remain inadequate. That dramatically expands the company's long-term revenue ceiling. Even if only a portion of these opportunities ultimately succeeds, the cumulative commercial potential could still be substantial. Investors should also appreciate management's disciplined strategy. Rather than pursuing dozens of unrelated therapeutic areas, AXSM has remained focused on central nervous system disorders. That specialization allows management to build scientific expertise, physician relationships, regulatory experience, and commercial infrastructure around a consistent area of medicine. Specialization often creates competitive advantages that become increasingly valuable over time. Doctors become familiar with the company's products. Sales representatives deepen relationships. Clinical researchers accumulate experience. Each successful launch strengthens the foundation for the next one. That kind of execution is difficult for competitors to replicate quickly. Of course, biotechnology investing always involves uncertainty. Clinical trials can disappoint, regulatory approvals can face delays, competition can increase. Those risks are part of every biotech investment. However, AXSM is no longer simply a promising research company hoping for its first success. It is already generating hundreds of millions of dollars in annualized revenue, commercializing multiple therapies, expanding approved indications, and advancing one of the stronger late-stage pipelines in the industry. That combination explains why many long-term investors believe the company could continue outperforming over the coming years. The stock has already rewarded shareholders over the past several years, yet when you examine the expanding commercial portfolio, the growing revenue base, the newly expanded label for Auvelity, and the multiple late-stage catalysts still approaching, it becomes easier to understand why some investors believe this story is still in its early chapters. For investors willing to accept the normal risk associated with biotechnology, Axsome Therapeutics represents something relatively uncommon, a company that is no longer purely speculative, a business with real products, real revenue, real growth, and multiple opportunities that could meaningfully expand its business over the next 5 years. That is exactly the type of profile many long-term growth investors spend years searching for. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second company is proving that sometimes being first can create an advantage that lasts for years. That is exactly where Madrigal Pharmaceuticals, ticker symbol MDGL, finds itself today. Unlike many biotechnology companies that have dozens of products spread across unrelated disease areas, Madrigal is focused on one of the largest unmet medical needs in liver disease. Its entire investment story centers around metabolic dysfunction-associated steatohepatitis, better known as MASH. Most people have never heard of MASH. That is precisely why so many investors continue overlooking this opportunity. MASH is a progressive liver disease that can eventually lead to cirrhosis, liver failure, liver cancer, and even the need for liver transplantation. Millions of people are believed to be living with the disease, yet for years physicians had almost nothing available to directly treat it. Patients were generally advised to improve their diet, lose weight, and exercise. While lifestyle changes remain incredibly important, many patients continue progressing despite their best efforts. That left a massive gap in medical care. Madrigal changed that. Its flagship medicine, Rezdiffra, became the very first therapy approved specifically for MASH in 2024. Being first matters. First movers often establish relationships with physicians before competitors have commercial products. Doctors become familiar with prescribing the medicine. Insurance providers gain experience reimbursing it. Healthcare systems develop treatment protocols around it. All of these factors create friction for future competitors trying to take market share. That does not mean competition will never arrive. It simply means the first company often begins with an enormous head start. Rezdiffra has already demonstrated exactly why that first mover advantage can become so valuable. Commercial adoption has been much stronger than many analysts originally expected. The company is on pace to surpass $1 billion in annual sales during 2026, an extraordinary milestone considering the medicine only reached the market a relatively short time ago. Crossing the billion-dollar annual revenue threshold is significant for several reasons. First, it validates physician demand. Second, it demonstrates successful commercial execution. Third, it generates substantial cash flow that can fund future research without relying as heavily on outside financing. That is an important transition for any biotechnology company. Earlier stage biotech businesses often need to issue additional shares to raise capital, which can dilute existing shareholders. As commercial revenue expands, companies gain greater financial flexibility. That is exactly where Madrigal appears to be heading. But perhaps the most exciting aspect of this story is how much room remains for growth. At the end of 2025, more than 36,250 patients were receiving treatment with Rezdiffra. At first glance, that sounds impressive. Then you compare it with the broader opportunity. From the beginning, management identified roughly 315,000 specialist-treated MASH patients as its initial commercial target. Do the math. Current adoption represents only a little over 10% of that initial target population. That means nearly 90% of the patients management originally planned to reach have not yet started therapy. Investors love businesses with long growth runways. This is exactly what that looks like. The opportunity is not dependent on discovering an entirely new blockbuster medicine. Instead, the company can continue growing simply by expanding the number of eligible patients already receiving its existing therapy. That type of predictable expansion often creates a more durable investment thesis than relying solely on uncertain future discoveries. Another factor supporting Madrigal's outlook is increasing awareness. When an entirely new disease category begins receiving attention from physicians, screening often increases. Doctors become more proactive about identifying patients earlier. Patients become more aware of available treatments. Specialists become more comfortable prescribing the medicine as they gain real-world experience. Each of these trends can contribute to rising prescription volumes over time. That creates a powerful compounding effect. More diagnosed patients create more prescriptions. More prescriptions generate more revenue. Higher revenue supports additional physician education and commercial expansion. That can accelerate growth further. The company's opportunity also extends beyond simply maintaining its current position. Management is actively developing additional MASH therapies designed to expand its presence within this disease category. That strategy makes a great deal of sense. Rather than constantly entering unfamiliar therapeutic areas, Madrigal is deepening its expertise in a market where it already enjoys meaningful leadership. Companies often create lasting competitive advantages by becoming specialists instead of generalists. If future products complement Rezdiffra, physicians already familiar with Madrigal may be more likely to consider those therapies as well. That could strengthen the company's position even further. Financially, the business continues moving in the right direction. Revenue growth has accelerated as commercial adoption expands, giving investors increasing confidence that management can execute beyond clinical development. For years, biotechnology investors primarily evaluated companies based on trial results. Once commercialization begins, execution becomes just as important. Can management successfully manufacture enough product? Can it build an effective sales organization? Can it negotiate reimbursement? Can it educate physicians? Can it scale operations efficiently? Madrigal has been answering those questions with increasingly encouraging results. Another aspect that deserves attention is the sheer size of the global market. MASH is not a rare disease affecting only a small number of patients. It represents a major public health challenge worldwide. As obesity, diabetes, and metabolic disorders continue increasing globally, the number of patients at risk for advanced liver disease is also expected to rise. That unfortunate reality creates a very large addressable market for effective therapies. Even if competing medicines eventually reach the market, there may be enough demand for multiple successful treatments. Healthcare history has repeatedly shown that large disease categories often support several commercially successful products. The market does not always become winner takes all. Instead, physicians frequently choose different therapies depending on individual patient characteristics. That gives companies with strong products meaningful opportunities to coexist. For long-term investors, one of the most attractive elements of Madrigal's story is visibility. The company already has an approved medicine. Commercial adoption is accelerating. The addressable patient population remains enormous. Future pipeline development could expand its leadership position even further. Those factors provide investors with a relatively clear framework for evaluating future progress. Every quarter brings new prescription numbers, new patient adoption, revenue growth, commercial expansion. Those are measurable indicators that investors can monitor over time. Of course, no investment comes without risk. Future competitors may introduce new therapies. Insurance reimbursement policies could evolve. Commercial execution must remain strong. Management will need to continue educating physicians while scaling operations responsibly. Those challenges are real. However, when a company enters a massive underserved market first, builds commercial momentum, and still has the overwhelming majority of its target population left to reach, the long-term opportunity becomes difficult to ignore. That is exactly why many growth investors continue watching Madrigal Pharmaceuticals so closely. The company is not trying to disrupt a mature market where every patient already has multiple treatment options. Instead, it is helping define an entirely new treatment category while building what could become one of the leading franchises in liver disease. If management continues executing successfully, today's commercial progress could represent only the beginning of a much larger growth story over the next decade. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our final stock may be the most overlooked of the three because it has already proven it can build a highly successful cancer franchise, yet many investors are focused almost entirely on what happens when its biggest product eventually faces generic competition. That is exactly what Exelixis, ticker symbol EXEL, has been doing. Exelixis has built its reputation around Cabometyx, a cancer treatment that has become one of the company's biggest success stories. The medicine is approved for multiple cancers, particularly kidney cancer and liver cancer, and it continues generating impressive commercial results. This is important because oncology remains one of the most attractive areas in all of medicine. Cancer continues to affect millions of people around the world every year. As researchers improve diagnostics and treatments, demand for innovative therapies continues to grow. Companies that successfully develop effective cancer medicines often enjoy years of strong commercial performance because physicians prioritize treatments that improve patient outcomes. Cabometyx has become exactly that type of product. Even though it has been on the market for years, it is still delivering healthy growth. During the first quarter, Exelixis generated $610.8 million in revenue, representing 10% year-over-year growth. That is a remarkable achievement for a company whose flagship medicine is already well established. It tells investors something very important. Demand has not peaked. The business continues expanding. Many mature pharmaceutical products eventually experience slowing sales growth as markets become saturated. Cabometyx continues demonstrating that physicians still see meaningful value in the therapy. That gives Exelixis a solid financial foundation. Steady revenue allows management to invest aggressively in research without placing excessive pressure on the company's balance sheet. Strong cash generation is one of the biggest competitive advantages in biotechnology. Companies with healthy cash flows can fund clinical trials internally, pursue new indications, and make strategic investments without constantly raising capital from shareholders. That financial flexibility becomes even more valuable during periods when capital markets become more difficult. Of course, investors are also aware that Cabometyx will likely begin facing generic competition around 2030. For many companies, that would represent a major problem. When blockbuster drugs lose patent protection, lower-priced generic alternatives often reduce revenue significantly. Markets know this, investors know this, management knows this. The difference is that Exelixis has not ignored the issue. Instead, it has spent years preparing for it. The company's most exciting pipeline candidate is zanzalintinib, and it has the potential to become the next major growth engine for the business. What makes this program particularly interesting is not just one successful clinical trial, it is the broader strategy behind it. Zanzalintinib has already produced encouraging Phase 3 results in patients with metastatic colorectal cancer, and the company could receive regulatory approval in this indication before the end of the year. That alone would be meaningful, but management is thinking much bigger. Rather than developing a medicine for only one specific cancer, Exelixis intends to pursue multiple cancer indications over time, much like it successfully accomplished with Cabometyx. That approach dramatically increases the long-term commercial opportunity. Every additional approved indication expands the addressable market. More eligible patients mean more prescribing physicians. More physicians create greater commercial potential. Instead of relying on one narrow niche, the company could gradually build another broad oncology franchise. That is why some analysts have described zanzalintinib as a potential pipeline in a drug. It is a fascinating concept. Rather than needing 5 completely different blockbuster medicines, one highly effective therapy may eventually receive approvals across several different cancer types. If clinical data continues supporting that strategy, the commercial opportunity could become substantial. The initial focus on metastatic colorectal cancer also deserves attention. Colorectal cancer remains the second leading cause of cancer-related deaths worldwide. Despite significant medical advances, there remains a considerable unmet need for better treatment options. Whenever a company targets a disease with large patient populations and limited effective therapies, physicians pay close attention. If new medicines improve survival or quality of life, adoption can happen quickly. That is exactly why investors are watching the upcoming regulatory milestones so closely. Success would not simply validate one clinical program, it would strengthen confidence in Exelixis' broader development strategy. Another aspect that makes Exelixis attractive is its experience. Developing cancer medicines is incredibly difficult. The oncology field is one of the most competitive areas in pharmaceuticals. Many of the world's largest drug companies devote enormous resources to cancer research. Despite competing in that environment, Exelixis has carved out a meaningful position. That speaks volumes about the quality of its scientific expertise and development capabilities. Success in oncology rarely happens by accident. It requires disciplined research, carefully designed clinical trials, strong regulatory execution, and effective commercialization. Exelixis has already demonstrated it can accomplish all of those things. That track record matters. When management has repeatedly executed successfully, investors often gain greater confidence in future pipeline programs. Past success does not guarantee future results, but it does provide evidence that the organization understands how to move promising therapies from the laboratory to commercial reality. The investment thesis also extends well beyond one pipeline candidate. Exelixis continues investing across multiple research programs designed to strengthen its long-term oncology portfolio. That diversified approach reduces dependence on any single future approval. Just as importantly, it increases the probability that at least several candidates will contribute meaningful revenue over time. This strategy mirrors what many of the most successful pharmaceutical companies have done for decades. They continually refresh their portfolios before older products begin slowing. Rather than reacting to patent expirations, they prepare years in advance. Exelixis appears committed to exactly that philosophy. From a financial perspective, the company also stands on solid ground. Strong commercial revenue provides resources to fund research while maintaining operational flexibility. That combination allows management to balance today's profitability with tomorrow's innovation. Investors often have to choose between early-stage biotechnology companies with exciting science but little revenue, or mature pharmaceutical companies with stable revenue but slower growth. Exelixis offers an interesting middle ground. It already has a successful commercial business. At the same time, it possesses pipeline opportunities capable of driving another cycle of growth. That balance makes the investment case particularly compelling. There is also an important psychological factor working in the company's favor. Markets frequently focus too heavily on known future challenges. Everyone already understands that Cabometyx will eventually face generic competition. Because that information is widely known, much of it may already be reflected in investor expectations. What remains less certain is exactly how successful Exelixis' next generation of medicines could become. If management executes better than expected, future upside could surprise the market. That possibility is exactly what attracts many long-term investors. Rather than focusing only on what the company may lose several years from now, they focus on what it could build between now and then. That shift in perspective often separates successful long-term investing from short-term speculation. Looking across all three companies featured today, a common theme begins to emerge. None of these businesses are relying on one lucky breakthrough. Each has already demonstrated meaningful commercial execution. Each serves markets with significant unmet medical needs. Each possesses multiple growth catalysts that extend well beyond the next quarter. Axsome Therapeutics is expanding an already successful commercial portfolio while advancing an impressive late-stage pipeline. Madrigal Pharmaceuticals is establishing leadership in an enormous liver disease market that remains largely untapped. Exelixis is using the financial strength of an established oncology franchise to build the next generation of cancer therapies. They are different businesses. They target different diseases. They serve different patient populations. Yet they all share one characteristic that long-term investors consistently seek. They are building businesses designed to become stronger over time. That does not guarantee outstanding returns. Every investment carries risk. Clinical trials can disappoint. Regulatory decisions can change timelines. Competition can emerge faster than expected. Markets can become volatile. That is why diversification and careful research remain essential. But for investors willing to think 5 or even 10 years into the future, companies that combine growing commercial businesses with promising innovation often deserve a closer look. Sometimes the biggest investment winners are not the companies dominating financial headlines every day. Sometimes they are the businesses quietly executing quarter after quarter while the broader market pays attention somewhere else. Those are often the opportunities patient investors hope to discover before everyone else does. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now, I would love to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage? Axsome Therapeutics, Madrigal Pharmaceuticals, or Exelixis? And which one do you think has the greatest potential to deliver life-changing returns over the next decade? Let us know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.